Welcome to today's podcast. Today's all about mastering wealth, and we're joined today by Alexandra Buchan-Heelas, who is a portfolio manager at 𝗍𝗲𝗏, and we're going to talk about 5 top investing tips from a pro. So welcome, Alexandra. Thanks for coming along.
Pleasure. Thanks for having me.
So where shall we start? I know we're in safe hands. You're the PAM top 40 under 40 for portfolio managers in your industry, and not just once but 3 times. So well done.
Thank you. I'm blushing.
And I hear that you look after almost $500 million of clients' money on your own. So we need to pick your brains.
Fire away.
So let's talk about market volatility. I think we've seen some real lows in the last few years and then some real highs, so it's made us forget about the lows. How do you manage volatility in a portfolio?
Yeah, it's a real challenge. It's one of the most complicated things psychologically to do when you're running money or when you're investing your own money. And I think ultimately the best way to think about volatility is that you have to look over the really long term. And over a very long period of time, equity markets have consistently provided you 6, 7, 8% compounded over time. But you don't get anything for free. If you want to get that upside, you have to be willing to accept the volatility and the ride along the way. And the more risk you take on in terms of volatility, the more return you can get. So if you are going to invest in a higher risk way, you need to be aware going into it what the volatility might look like, and then mentally prepare yourself ahead for that volatility that will inevitably come.
So just accept it.
Yeah, to be honest, I think if you go in knowing what you want to achieve long term, understanding the investments that you hold, understanding what the volatility has looked like historically, so you can sort of prepare yourself and buckle up for the ride.
Yeah.
The worst thing you can do is feel pressure to sell when that volatility happens and when markets fall and markets are weak. That's the worst possible outcome.
And I suppose if someone, say, goes on Trustnet and looks up a fund that they're going to pick for themselves, they go back for 5 years, they're still going to get that COVID fall in. So they can see when it's bad, this is what it's done in the past, to really, I suppose, imagine themselves in those in the shoes of that person who's just lost 10, 15, 20% overnight.
Yeah, that's exactly it. So in our initial client questionnaires, when we start looking after a new client, we say to them, how would you feel if your portfolio fell by 20%? Because it's not just about the pound, shilling and pence. It's actually about what's your reaction going to be as an individual. And you have to, as you say, put yourself in those shoes. First and foremost, are you going to be able to pay your electricity bill and still put food on the table? That's got to be covered first of all. But second of all, are you going to panic, want to sell, want to exit everything? And if that's the case, you need to go a little bit lower in terms of risk, because the worst case scenario is that selling at the point of lows in the market, not only because you're going to miss some of the upside, but also because getting back into the market when markets rally hard is incredibly challenging. So during COVID, markets fell by 20% in very short order, but they also rebounded really quickly. Not only that, not too distant future, they hit all-time highs. So if you'd sold in March, April, and you were panicking about trying to get back in while markets are going up, at what point do you say, oh, I'm going to go in when you see markets going up month after month after month? That's really, really challenging psychologically to do.
And I did read that we feel the pain of a loss twice as much as we would feel the high of the same amount.
Yeah.
So we just have to be prepared that psychologically we're going to try and sabotage ourselves.
Exactly. It's a behavioural finance theory called loss aversion, whereby, as you say, the downside hurts way more than the upside gives you in terms of joy. I think if I was going to give someone advice in periods where markets are volatile, when you open the newspaper and the headline is stock market's falling, stock market's crashing, do your best not to look at your app, not to log into your website, and try your very best to just put it in the back of your mind. Have faith in the investments that you've chosen. Have faith in the long-term outcome for equities, which, is, as I say, has consistently been good over a long period of time, and try your best to ride it out.
And ideally buy more.
If you can.
Yeah.
You're right. The best thing you can do is do the exact opposite of what you want to do. So when markets are weak, that's the time to buy. And then when they've been really strong, that's the time to take some profits and take some money off the table. But actually that momentum on the way up is quite enjoyable.
Yeah.
So again, it's counterintuitive to want to sell at that point.
I'm sure some people are probably thinking, what is a portfolio manager and what is an IFA and how do we differ? So, I mean, I'll explain my bit, maybe you explain your bit. So my job would be to look at someone's overall financial situation and look at all the assets that they have and the plan that they want to create, then put those bits in place. How much are we doing? Pensions, ISAs, general investment accounts, things like that. And then I would find the right investment manager for them. And some clients will just track the market, some clients will have somebody like you looking after them, and some people just sit on the fence and have a bit of both. And then I pass it to you. And what do you do next?
Yeah, so we just do that one part of the puzzle where you are looking at the whole picture. We're just looking at that individual portfolio. What's the purpose of that money? What's your outcome? What are you hoping to achieve? And what risk you can take? And we then invest that pot, be it a GIA, an ISA, or a SIP, or a combination of the three, to try to achieve that specific outcome for a client. And as you say, some people go down the tracking route where they invest via trackers. We are what's called active managers, whereby we pick individual companies to invest in and indeed companies not to invest in to try and give the best return over the long term.
And I spend a good portion of my working life looking at who's good in your industry and who's performing well. And I think it is about the performance and it is about the team. But you and I were speaking just before we started recording that actually it's about, do you fit that company's perfect model? Because some organisations, if you haven't got more than 5 million or 10 million, you're really not their target market. They're not going to bend over backwards for you. You're not going to get brilliant service. So if you were a lay person, how do you even begin to know who's good in your industry?
Yeah, there are a few websites that will show you lists of all the available options to you. And once you've narrowed it down, I think some of the key things you've got to think about and look at. You mentioned performance. That's really important. How have they performed over time? And a couple of key points there. You want to see that after fees. You want to see performance that takes into account how they've done relative to the peer group. And you want to see performance of real portfolios, not just of a model that they've put together, which is much more easy to change over time. That's a way to get a really good picture of how they've performed. And to our earlier point, it's worth looking at how they've performed in negative years as well as in positive years and the consistency of that performance over time. And then the other thing is the service element, as you mentioned. So finding somewhere where you're not going to be a tiny fish in a huge pond and you're going to get overlooked. Find somewhere where you trust people. Ultimately, this industry is all about trust. So can you work together if there is a period of market volatility and your advisor says, look, hold on, things are going to be okay? Are you going to be able to listen to them and trust them to do that? So I think that relationship element of it is really important. And incidentally, the thing that I like most about my job, actually.
It's why you're probably very good at it. And what about, what websites would I look at if I didn't know where to start?
Yeah, so you mentioned PAM earlier. So they provide a directory of investment management companies that you can look at. And then there are a few others. There's one called Find a Wealth Manager, where you can put in some of your details and it will come out with a result of someone who might be in your region or looks after your type of investments or whatever happens to be.
And can we get some gossip? What's the worst mistakes you've seen people make before they come and get rescued by you?
The worst thing that people do, and I mentioned it briefly earlier, is selling when they panic. So in our industry, the biggest risk to a client, I think, is that sale when markets are bad. We saw it a bit in 2008, and we saw a little bit in COVID, but actually much less. The risk of permanent capital loss, because volatility is one form of risk, but permanent capital loss is another, and actually much more grave and much more difficult to come back from. So that's the biggest issue that I think people have. The other thing that we see with clients before they come to us is they might have a very sizable holding in one company that perhaps they'd worked for or one of their parents worked for. And we work with them to try and reduce that single exposure that they might have, to try and give them some more diversification, which ultimately is a form of protection, gives you much more optionality. But yeah, having one sort of massive holding in your portfolio is something that quite a lot of clients do have.
And I suppose I see that very common in my client base, where you get, we look after lots of tech, so Googlers and Microsoft, and they'll have a lot of their shares awarded to them every year in that, and then there might be in trackers behind the scene which then are very heavily exposed to US tech anyway, so they're doubling up and being extra exposed to one sector. What other mistakes do you see? Well, let's put it on the positive. So the first tip was manage volatility well. What other tips would you give people?
I think some of the other things that you can think about is understanding what is a risk to you. So volatility, capital loss, also liquidity. Are you going to need that money in the short term, and invest accordingly to take that liquidity into account? If you do have a long-term time horizon, then I think being more adventurous and investing for the long term is a great thing to do, and a great way, ultimately the best way to grow your capital. If you're too conservative, you're going to be hit by inflation. That's going to impact you, bit by bit over the years, till your money is effectively worth a lot less than it was at the beginning. So being willing to be adventurous, but also being diversified into different kinds of stocks is going to give you the best opportunity to grow.
And by being adventurous, I would say one mistake that I see is people kind of turn investing into gambling by going almost all in on red, all in what, maybe that's one sector, but I see it sometimes just in one stock, in one theme, and that's always worrying for me.
I think that's a good point, because the joy of winning, that feeling of winning is quite, can be quite addictive effectively, and really enjoyable. So I think, the statistics say that you need to have at least 20 stocks in your portfolio to give you adequate diversification. And we would go a little bit further. We would say maybe between 30 and 40 gives you a good spread. Because those stocks that have really good momentum, you've mentioned tech companies as a good example, when they're going up, sort of when it's good, and when it's bad, it's horrid, because everything goes up together with momentum. And then if things change and it turns around, they're going to come crashing down quickly as well. And we have seen that over the last 5-10 years. Tech stocks have driven so much of performance and been really the only game in town, particularly US tech stocks. But we think it's important to have some exposure outside that sector. So if things change and something unexpected happens and they come down, you have something else in your portfolio that balances that out. So having a good spread in terms of style of stocks for us is really important.
And I suppose you're not trying to just be the best in every year, because that could also mean that that strategy has meant that you're worst when it really goes wrong.
Exactly. So at Waverton, we sort of think about if we can be around the top 25% mark each year consistently, we just gradually can outperform relative to our peer group. And if you look at the graph of our performance, you can see that. It's not about, putting a big bet on Brexit happening or Trump winning the election. It's just about consistently choosing good companies that perform a little bit better. And then over the long term, you can try to get that outperformance relative to the peers in the market.
A lot of your clients in that accumulation phase, so they're building their wealth. How do you get them to grow it at a sensible rate? Like, are they putting in lump sums at the end of the tax year, doing monthlies? How do you get them to do it well?
Yeah, I think the monthlies can be very helpful because it's sort of out of sight, out of mind. And if it's set up and regularized, I think that's the easiest way to save. I think by putting it into a portfolio at Waverton or wherever else, that also is good psychologically because it's not in your bank account.
It doesn't feel like yours.
Exactly. So if you're just moving it, from your main account into a cash ISA on your app, you can as easily move it back again. Whereas if you're sending it off to a portfolio manager, it's being invested in your ISA or your SIP or whatever it happens to be, that's out of sight, out of mind.
And you've got to ask for it back.
Exactly.
You've got to ask a human.
You do. And we talk to our clients a lot about, what's a sensible rate to take things out of your portfolio to not erode that capital.
What would you say is the rule of thumb?
We normally say under 60, you want to be thinking about 2.5%. Over 60, it can probably go a little bit higher. And that is a rule of thumb, as you say. But any more than that, you're going to get into erosion of capital and, destroy all the hard work that we're trying to do with the investments.
And the way I would set up sort of a system is we get everyone to pay into their general investment account throughout the year. The beginning of the tax year, we're filling the ISAs. And then at this time, sort of the end of the tax year, is when we're thinking, right, out of that money that's in the general investment account, what do we need to put in the pension to be the most tax efficient that we can be? So if you're just paying in monthly, you don't necessarily need to be driven completely by the tax planning until the end of the tax year. I think I just spoke to a lady today who'd overpaid her pension, which is so annoying for being keen, and then she overpaid by about 30,000 into her pension, and so it meant that she's going to have a tax charge. So I think if in doubt, leave it till the end of the tax year.
And those pension contributions are going to be more important with this national insurance rise, aren't they?
Yes,
even more beneficial.
Yeah, it's going to save you more money. Okay, and then any last tips before we leave it there?
I think one thing that I would say from a UK investor perspective, we're both based in the UK and most of our clients are based here as well. don't just think about the UK stock market. You've got to think globally. I know a lot of the trackers take global investments into account, but the UK market has a lot of issues. The UK economy currently has a lot of issues. It's not the most diversified stock market out there. You need to be thinking not just about the UK, but actually about the world overall and invest internationally.
Yeah. It's a good point, isn't it? Because I think when someone comes along and they've got a share portfolio that maybe their granddad had and passed it down, they would predominantly be a UK portfolio of stocks and shares, wouldn't it? And when you say about the UK not being very well diversified, what do you mean?
So if we look at the kind of sectors that the UK stock market is made up of, there are a lot of cyclical and more value type sectors. So we've got a lot of energy, a lot of mining, a lot of those kind of stocks. Whereas if you look at the US, by contrast, there's a lot more high value tech companies, service companies, etc. So you've got quite a different makeup of the stock market, and where all the action's been and where all the gains have come from are from the US and from technology. So just for reference, the US stock market makes up nearly 70% of the world's equity market at the moment.
That's bonkers.
Up from 50 just 4 or 5 years ago.
There's no wonder those tech bros are feeling really powerful.
I know. It's astounding. Yeah, and the Magnificent Seven is sort of 30% of the S&P 500. So it's a huge level of concentration, which comes with all of its own risks. But I think important to not just, if you do have one of those inherited UK type portfolios, my suggestion would be that you want to diversify that and you want to have a good allocation to the US.
And when you're building a portfolio that, I mean, I see typically now even less than 5% in the UK would be very common in someone's portfolio. Yeah. How do you manage, or can you even manage, a currency risk?
Yeah, it's a good question. So the way we think about it is you've got your equity allocation, which we do not hedge currency in. So things are moving up and down all the time. But we are not currency experts. And people who try to hedge currencies, I mean, hats off to them. It's just incredibly difficult to do. But then the other parts of the portfolio, the cash, the bonds, and the alternatives, the things that are in the portfolio to try to reduce the risk, we hold all of those in your home currency, so sterling in this case. And that brings some of the risk down. And within the equity part of the portfolio, the other thing to think about is a lot of those companies themselves are doing hedging. So you take a UK company that sells overseas, it will be hedging sterling back into dollars back into sterling. And if you're then hedging that another time, you can end up doubling up or doubling down. So we let the equities just float in terms of currencies, and it normally ends up evening out. Of late, not having as much sterling has been really beneficial, sadly, as someone who lives in the UK and earns in pounds. But having lots of dollars in the portfolio has been a big benefit over the last 5 or so years, particularly since Brexit.
Well, thanks for all the tips. I'm sure everyone's brains are full, and we'll make sure we have you back to pick your brains again.
With pleasure.